always something. I had to go get a rent check here. I had to run to the bank there. I had to show up to closing over here. And it's like I just felt like I could never get away, and we couldn't really vacation. And that's so important to us. And that's why, again, self-awareness, strengths and weaknesses. What are your goals? To us, it's a lot about travel, and passive investing is a lot about lifestyle.
Welcome to the InvestNest Real Estate Investing Show, a community for real estate investors to learn, network, and grow. Be sure to join the investnest.com and start learning and earning today.
Hello, everybody, and thanks for joining me today on the InvestNest Real Estate Investing Show, episode number 14. This is your host, Travis Murphy, and I'm very excited about today's show. We've got another awesome Invest guest lined up, a fellow Travis, which is a first. So you're going to be hearing Travis interview Travis, which is pretty wild. But before we dive into that, I want to remind everybody, if you're listening to the podcast, please hit the subscribe button so you don't miss out on any of our future shows. As well, if you haven't checked out the investnest.com already, please go visit the website and create your free investor profile. It's very easy to set up. And once you log in, you can have access to our articles and blogs, as well as network with other members. And of course, follow along on all of our social media, Instagram, Facebook, and Twitter at The InvestNest. All right, so now let's get on with the show. I'm going to welcome Travis Watts to the show. He's been investing since 2009, but he's got a ton of things going on. So I'm going to give him a quick introduction and then let him tell us a little bit about what he does. Travis, welcome.
Thanks so much for having me, Travis. I am thrilled to be here. This is perfect. I'm so glad you reached out because I have two things real quick that I'm super excited about. One, I love to educate others. So as far as your site and your blogs, your articles, your content, that's fantastic. And two, I'm a huge advocate for networking and meeting others in the space. So what you're doing is fantastic. And thanks so much for the invite.
Awesome. Well, we're very glad to have you. All right. So for everybody out there listening, Travis, he's the real deal. This guy is legit. He's got a lot of things going on. He's done investing from what I understand. I don't know Travis well, but from what I understand, he's done residential, multifamily, and it sounds like maybe even some syndicating. I'm not positive, but could you just tell us a little bit about yourself and what it is that you do?
Sure. Yeah. I'll give a real quick backstory here. So as you pointed out, I got started in 2009 in the single family space on the active side. So probably how, 80% of people get started in real estate. And so didn't know what I didn't know, didn't have a good network, which is why I'm such an advocate for networking and meeting others who are in these spaces doing different things. I just was pushing forward off my own little bubble of knowledge, which was very small. I'd read a couple books, didn't really have, a family background in this or anything. And so I started house hacking, just renting out a spare bedroom. That kind of opened my eyes a little bit to an idea of passive income. So, receiving a check basically that I didn't have to work for per se. And so that kind of got the wheels turning. A few more books later and got into fix and flips, vacation rentals, single family buy and holds. And I'm trying to manage all this stuff while working in the oil industry. So 14-hour days, 98-hour work weeks, working out of state, working overseas, always away from home, no spare time. It was crazy. And I really grinded it out for many years until I burned myself out, which was 2015. And I thought, there's got to be a lot of people in my position that are career focused, maybe a doctor, dentist, lawyer, attorney, athlete, business owner, you name it, right? That maybe don't want to get out there and be active in this space, but perhaps invest in real estate somehow. So how do you do that? And that's where I discovered passive investing. So today I invest in multifamily through private placements, so apartment syndications with other people who are really doing the legwork and the heavy lifting. And I'm just kind of the passive side of that, sending in a check and then sharing in the distribution. So that's kind of the quick recap. So 2015 through today, I'm full-time passive. And so a lot of my content, blogs, articles, and how I help people is on that side. But I'm happy to discuss here today the active and the passive side and kind of the pros and cons, if you will.
Yeah, absolutely. That's great stuff right there. I think it sounds like you took the kind of the natural progression. To me, with real estate investing, that's kind of the order of things. You know, people
Yeah.
seem to get interested early on when they maybe hear about somebody else doing it or see a TV show about house flipping, and the natural starting point is like a house hack, right? It's probably the easiest way to get into investing. It's easier to qualify for the loans. It helps you pay your mortgage, and you get a little taste for actual income that you're making without working. And that's usually what gets people excited, and then move on from there. So for you, how did you get, what was really the deciding factor from when you're grinding it out after all these years trying to work your regular job and then do all these side investments? Was it somebody else that you networked with? Did you have a mentor, or what caused the light bulb to go off to make you make that full commitment, that full-time commitment?
Yeah, good question. So there were a few things, and I describe it this way. If we back up to about 2013 and 2014, so as I'm moving to that burnout,
Yeah.
the light, instead of, there being a light at the end of the tunnel, it was kind of closing in for me. And I thought, this is not going to be scalable. This is not going to be sustainable, at least not for me, where my skill set and background isn't being a handyman or being active or building big networks of contractors and all of this.
Yeah.
It was just really not my thing. And so now today I'm really big on, self-awareness and trying to evaluate your strengths and weaknesses and what might be most suitable for you as an investor. And I wish I had gone through some of those exercises back then, because I went through it the hard way, just pushing myself right in the middle of it and then doing a lot of things wrong and burning out, making mistakes until I decided this really isn't for me. Couple things. I knew I had to make a change in my approach to real estate. Simultaneously, I knew, being in the oil industry as such a boom and bust type of, career field, I was going to be laid off or fired eventually. And so, this income I had and this job that I had was not going to be around forever, and just look at oil today and how bad oil companies are suffering. I mean, had I stayed, I would definitely not be there today. So, and it was coincidence that right after I resigned, mass layoffs came anyhow, because oil had fallen out. So 2015 was a crazy breakthrough year for me. As I mentioned earlier in our call, big advocate for self-education, reading books, listening to podcasts, finding mentors, networking. So I did all of that. And on the book front, that was my main focus. And I read 52 books in 2015. So I took a few speed reading courses, figured out how I could actually accomplish a book a week. And I did that, which I don't recommend, because it was way too much information. It was like, just a fire hose opened up in my face, and at the end of the year, it's, what was the real practical takeaway here? I don't know. I learned a bunch of stuff about a lot of things, but
I mean, that's pretty impressive.
I guess. But again, what would have been probably smarter is maybe like 10 books that year, or 5 books, and really, diving deep and trying to absorb it, maybe reading them twice, taking notes, taking action as I read, whatever. That's what I did. And simultaneously, I discovered this passive side. As I mentioned, I knew people. Like, I was a big fan of Robert Kiyosaki and the Rich Dad series and Rich Dad Company. Well, I knew he was a passive investor. He wasn't out there, swinging hammers and flipping houses. So
Yeah.
like, how does that guy do it? And so that's where I discovered syndications. He's, in fact, he invests as a limited partner as well in a lot of syndications, or a JV partner perhaps. And he has some individual ownership, but everything's outsourced. He's not really doing much anything on his own. So that's where the light bulb really went off, is when I discovered that concept that you could actually be a hands-off investor, not just in terms of like the stock market and publicly traded REITs and whatnot, but in private real estate holdings. Right. And reflecting to myself and thinking, I'm doing these fix and flips. I'm not that profitable. I'm not finding great deals. It's a ton of work. It's a lot of risk for me anyway. I just discovered it's a better approach. Why don't I go seek out people actually doing this the right way, that have track record and reputation and proof of concept, and they're passionate about what they do? Why don't I just go partner with them? Say,
Yeah.
here's some money, you go do the plan. I trust in your abilities because I don't trust in my own. And, let's share in this deal. So that was kind of the light bulb moment. There was, the story goes on, but more or less in a nutshell, that's more or less what happened. And I ended up selling all of my single family homes and the house I lived in, going completely liquid, completely cash, and then going into these private placements, just one at a time, done a little over 30 at this point. And
Awesome.
that was the progression.
Awesome. Sounds like it's turning out well for you. There's a lot of good stuff there. So some of our listeners may not fully understand what we're talking about between,
Sure.
active and passive, even when you're talking about investing.
Yeah.
People think active, you're thinking going to a job. But what Travis is talking about is, a lot of when you're first starting in investing, and some people stay in this arena, but it's residential, either, single family homes or small multifamilies, 1 to 4 units. And that you can do good with that. That's great, but there's a lot of work typically involved, whether it's you're flipping houses, or you're self-managing, or you have to go out and find additional investment properties, typically rehab them. The next stage on from that is the larger scale investments, typically multifamily apartments, and what a syndication is where multiple people come together. You said yourself, being self-aware and realizing your strengths and weaknesses. Well, partnering with multiple people, it's not just about bringing money in. I would imagine you have somewhat of a team, and each of you guys on your team, have your strengths that you tackle. But for many out there getting started in that, it does take money, and pooling people together with money allows people to perhaps take on a larger investment that they would not be able to, which also for some people out there may not have the time. If they have a full-time career and they don't have the ability or the option to quit their job or scale back hours, but they may have accumulated some cash and they want to put it into an investment where they can reap the rewards passively, that's where you come into play. That's what a syndication is. So can you tell our listeners a little bit more about a syndication and what that really means and what it is?
Yeah, 100%. And thank you for breaking that down. Sometimes I get carried away in the jargon and terminology, just so used to, talking about this stuff daily. But yeah, so basically, if you had asked me back in 2009 about investing in a 400 unit apartment complex and how you go about doing that, I probably would have had 2 answers for you. Either A, you have to be a billionaire, or 2, you have to have like 40, 50 years in the real estate space to graduate to that level. And it's funny to think about that because a lot of folks, I realize now, actually start in that space. To your point, the medical professionals, and as I mentioned, doctors, dentists, lawyers, attorneys, folks that are typically, just to use a practical example, say they're making, $200,000 a year in income. Well, they're living on $100,000, let's say, and, they've got some excess money to go invest or put to work elsewhere. Well, not everybody wants to go dump 100% of that into a 401k or
Right.
into the stock market. And that's where, this real estate piece can fit in, if nothing else, just for a type of diversification where you can actually be a little outside the public markets. So, yeah, that's kind of the beauty of it. So what it is that you have general partners, okay, the sponsorship team. They're the folks that go out there and they find these opportunities, this 400 unit apartment complex that we're talking about. And they underwrite the deal, they crunch the numbers, they run their surveys, they walk the units, they pair together, some attorneys to put some legal docs together, and CPAs and property management companies, and they piece this together as an investment opportunity. And then what they do is they present that to limited partners, which is what I am, and they're passive investors. And so typically the passive investors like myself are bringing the bulk of the money to the deal to put down the down payment and the rehab budget, any reserves necessary. Just like you can imagine buying a single family home, you've got closing costs, you have miscellaneous things, and a rehab budget to flip a home. So we're all bringing that capital, and then we're all sharing in the cash flow if it's that type of project, which is what I invest in, and any potential equity upside down the road.
Right.
As we rehab, bring rents up, stabilize the asset, increase occupancy, things like that. And so, that's kind of the circle of life and what we're doing. And so the beauty of it is, from my standpoint, is I can be a partial owner in a 400 unit apartment complex that's not even in my home state, that's professionally managed and taken care of for, let's call it $50,000. Equally so, in my own market, if I did single family, I might have to put 50 to 200,000 down just for a single family home if I'm going to flip it, And so it's a nice diversification strategy. A lot of them are only available to accredited investors, which we can get into, but also equally so, a lot are available to sophisticated investors that can just understand the risks and what they're getting involved with and how the business plan works and so on and so forth. So don't be mistaken that all these deals are only for high net worth, high income individuals, but a lot of them are. So something to be aware of. It's a capital game. It takes a little bit of capital to get going as a limited partner.
Yeah, I mean, man, there's so much there. The multifamily investing, the syndication, what you're talking about, I get really excited about that. The financial modeling behind it. I mean, it can be really complex if you want it to be, but the fundamentals of how it works are fairly simple if you can understand a few key indicators on the financial side of things. And what you were talking about, as far as people putting in the work and having to go and renovate the property, the general partners, not renovate the property, but upgrade the property, what have you. That's forced appreciation, basically. And then you, as a limited partner, you get to realize not only the excess cash flow that's coming off of the investment, but also any upside equity gains, which typically is going to come not only from forced appreciation, but also from your principal pay down over time. And all that stuff, to me, like, I get excited about that. You can analyze a single family or duplex, and you can see it clear as day, the cash flow and the returns it's going to provide. A lot of people will look at like cash on cash return. Well, when you're looking at a larger investment scenario like you're talking about, a lot of it's the same. There's a couple of other things that you need to keep track of, but the returns, not just diversification for people that may not have the time and want to invest passively, but it's diversification from the regular public markets, but the returns can be great. I mean, you can reap some great returns on, like you said, say a $50,000 investment. But for people that may be interested in getting into this, if they haven't done so already, you did mention an accredited investor. Can you talk a little bit more about that and what it takes for somebody that may be looking to get into investing in real estate on the passive side in the private markets?
Sure. Yeah, absolutely. So this accredited investor definition has been around for many, many years, and it's very slow to change and update. It's kind of a somewhat outdated thing in my opinion.
I think it scares a lot of people off too. I think it puts a fear factor in people and prevents them maybe from getting into investing in these types of investments.
Sure. So here's kind of where the SEC, the Securities and Exchange Commission, is coming from, is if you're going to do a private offering, then perhaps there's a little less reporting and transparency to that. Perhaps there's a little higher risk level to that. Perhaps, right? It just kind of depends. And what they don't want to see happen are American people putting in their very last dollar into a high risk investment and then losing money and then not being able to recover from that. Okay. And so what they did is they came up with this definition. It's a much longer definition than what I'm going to give you. You can look it up on the SEC website, but more or less, if you're an individual, unmarried, you need to, or here, you can choose either side, have made 200,000 in gross income for the last 2 years with the expectations that you'll make the same in the current year. That would be the income way to qualify as an accredited investor, or have $1 million net worth excluding your primary residence. And if you're married, it's still the 1 million net worth excluding primary residence, but the income requirement would change if you qualify that way for 300,000 in combined gross income for the last 2 years. Expectations of meeting the same in this year. So their theory is if you're making that kind of income or you have that type of net worth and you go put 50,000 into one of these deals and it goes to zero, you can still recover. You're not going to be in a financial hardship where you're doomed. So that's why they came up with this definition. Again, they're actually expanding it here recently. They've added, they've expanded that definition to go on to say folks that perhaps have a like a Series 7 or 65 license, like a broker dealer type of stuff, financial planners, advisors, whatnot, that they can be deemed accredited investors just because of the sophistication level that they would have to have being in that profession. So, it's slow. That's taken decades and decades and decades to even get that one step in the right direction. Yeah. A lot of people fighting for let us all have opportunities to these deals, but rightfully so, there needs to be some level of regulation, which I agree with. So anyway, it depends on the offering, and I'm not going to get down this rabbit hole, but I'll point this out. There's usually two common ways to structure a syndication. There's a 506C, C as in Charlie, which would be accredited investors only. And it has to be third-party verified by a CPA or an attorney or broker dealer. Or you could do a 506B, B as in boy, where if the general partnership so chooses, they can let in up to 35 sophisticated investors, as I mentioned earlier, that have the ability to understand the risks of what they're investing in. They're at a sophisticated level of understanding, but they may not meet that income or that net worth requirement. And so those do exist. Those do exist very broadly. You may not have seen them or heard of them because you can't publicly advertise those. That's one of the rulings of the SEC. And with the 506C, you can publicly advertise. So that's where a lot of people get this illusion that, hey, all the deals I see that are out there on the internet say 506C accredited investors only. So it must all be accredited, but it's really not. It's, I don't know the percentages, 50-50 we'll call it, but there's certainly a lot you could participate in.
So it sounds like to qualify for the accredited investor, it's more about your net worth, your financial situation. But the point of it is to make sure somebody kind of understands, is at least financially sophisticated enough to understand the investment that they're making. And as far as, is this the case with, as far as what the offering is, if it's like almost like a public offering or marketed, it has to be only to accredited investors. But if it's something that you would consider more of like a private offering to friends and families, then that kind of would be the B as in boy example that you gave.
Yeah, that's kind of the benefit of doing a 506B. To your point, you can technically allow friends and family to join with you in this investment because of that sophistication, requirement, or the ability to bring on 35 sophisticated investors. There's one more caveat I didn't mention with 506B. You must have a pre-existing relationship with the people that are going to be investing with you. So you can't call up an operator doing that type of offering as a complete stranger and just say, show me your deals. What do you got right now on the table? They can't do that legally. They have to first understand you, your risk tolerance, your goals. It's not clearly defined like each bullet point they have to understand, but they need to have a reasonable understanding of you and your objectives. Then let's say they have a deal come up 30 days later, 60 days later, they could email that deal to you and say, hey, we know you, you know us, here's our latest deal. It's 506B. With a C, you can go right to the point. Someone can technically find it online. Here's an open deal, go wire $100,000 to it. And there you go. You're invested. So
it's that pre-existing relationship that needs to be established. And I guess even with that, from what I understand, there's some gray areas as far as what they consider a previous relationship or not. But we're probably getting, like you said, a little bit down a rabbit hole. I get a kick out of all this stuff. I really enjoy it. But real quick, if I can get you, before we wrap this up, if I get you just to tell us, what are some of the, I'm not sure if you're the financial guy or not, or what your role is with what you do, but like, what are some of the financial indicators that people would look for if they're looking to analyze a larger multifamily investment?
That's a great point. So there's a lot of ways I could answer that question. I do have a completely free PDF guide I'm happy to give out to your listeners. Awesome. And that goes through how to vet a deal, a market, a sponsor, industry terminology, questions to be asking. It's a whole bunch. It's 20 pages, but it's dense. And so I'm happy to give that away if you want to put that in the show notes. Awesome. But basically, what I invest in specifically, I'm a little more conservative in this space. So what I don't do is a lot of new development or what they call opportunistic plays. So taking something with 20% occupancy and trying to increase it to 100. There's a lot more risk and stuff like that. And in both those examples, you typically don't have any cash flow, at least not for a while. And because I live on cash flow, that's important.
Yeah.
That's my paycheck in a sense. And so I look for stabilized assets, which means that the occupancy level is 85% or greater upon takeover. And then we're naturally turning units over. What I mean is we're not kicking our tenants out and going way down on the occupancy and renovating and bringing tenants back. We're starting with the units that are already vacant day one, renovating them, letting everybody on the property know rents are going to be increasing $50 a month. If you'd like to move into a new renovated unit, feel free. A lot of people take that option. Now their unit that they were in is vacant, and then we're going to start renovating those. It's a natural progression. It takes about 2 or 3 years on average, and then we get through a large apartment community that way. Yeah. And for the folks that choose not to move out, you certainly don't have to, but the rents are incrementally increasing. So, take it or leave it, I guess.
Yeah, I mean, and that's back to like we were talking about, like that forced appreciation. That's a whole nother aspect to the larger multifamily investing, another benefit that comes into play, that comes into play with it there. Yeah. I mean, I could go on with you with this stuff all day. I mean, there's so many things we haven't talked about. The ability to leverage the banks out there, the federal funding that's in place for these type of investments. I mean, you said earlier about one of the benefits of like a syndication is pulling people together for not only their abilities, but also their financing. That's another form of leverage. You're not just leveraging banks, but you're pulling people's money together, to leverage the ability to buy a larger scale project that you may not be able to. Like you said early on, your thought was that you have to be a billionaire to do this stuff, which isn't the case. You pull people together, you're able to leverage each other's abilities and financial strengths and take something like this down, and everybody reap the rewards. Well, I know you're a busy guy. What do you do for fun? Now that you're a passive investor, so I imagine that frees you up to do some of the things in life that you enjoy. Can you tell us a little bit about some of the activities you have going in life outside of the investing world?
Yeah, this is funny. I'm a fan, if you will, of the FIRE movement, Financial Independence, Retire Early. And a lot of that movement, I know it gets a lot of bad rep and people get confused by that acronym, FIRE, but my wife and I watched a really good documentary a few years ago on this, and the couple in that documentary sat down. They were in San Diego. They had a newborn daughter, and they thought, they're living in a very high tax state, a very high, income area, very expensive to live there. And they sat down and they wrote down 10 things that make them the most happy, either on a daily, weekly, or monthly basis, right? And then they shared that with each other. And my wife and I went through that same exercise. And so much of those top 10 were about travel. It was about experiences. Yeah. It was about visiting friends and family, which we don't have a lot here locally where we are. And, by the way, my wife works for an airline, so we fly inexpensively, we'll say, at least for now. The airlines are in shambles. But anyway, so we thought, hey, we want a lifestyle that allows us to travel, as much as possible. And before COVID hit, we were going around to Asia and Europe and, all over the place and doing these types of trips. And so for us, it's a lifestyle thing. I specifically remember all the instances where I felt so handcuffed to the ground when I had all these single family rentals in a 30-mile radius, and it was always something. I had to go get a rent check here. I had to run to the bank there. I had to show up to closing over here. And it's like, I just felt like I could never get away, and we couldn't really vacation. And that's so important to us. And that's why, again, self-awareness, strengths and weaknesses, what are your goals? To us, it's a lot about travel, and passive investing is a lot about lifestyle.
Yeah. So, I mean, I think everybody can relate to that. Everybody out there listening, I mean, traveling having time, really. I mean, and that's the whole thing. You're either trading time for money, or if you're investing passively, your money's making money for you to go do the things that you enjoy. Well, this has been awesome. I seriously could just keep going on with you. Hopefully we'll have you back at some point. Who knows? Maybe we'll even kick off the Travis and Travis Real Estate Show. But I want to thank you for joining us on the show. I believe your website is Ashcroft Capital /connect with Travis is how people can reach you. But if you could just tell us real quickly, where can people find you? If you have anything that you're offering right now, anything you want our listeners to hear or know about you.
Sure. Before I forget, I mentioned that guide earlier. So to your point, ashcroftcapital.com /connect with Travis has two things on there. It has that 20-page free PDF. There's no upsell to it. It's just 100% value add to your listeners. Number two is on that same page, you can book a 15-minute Q&A call with me. Again, I don't do coaching or mentoring on a paid service or platform. This is just free Q&A. Anything we discussed here, I know a lot of it was, complex and there's a lot, deeper we could go. And I'm sure a lot of people have questions about their own situation and how what we're talking about may or may not pertain. So please take me up on that offer. That's how I give back, is I give back my time to others. Both actively, passively, single family, multifamily. If I can be a resource, please reach out. ashcroftcapital.com /connect with Travis.
Okay, sounds good. And then I guess social media, your Instagram, Facebook is Passive Investor Tips.
That's right. Yeah, I didn't mention I'm on Facebook and Instagram and all over the place. So Google me, Travis Watts, and you'll connect with me somehow.
Awesome. Well, thanks so much, Travis. I really appreciate you joining me. This is probably one of my easiest podcasts because I didn't have to worry about forgetting the guest's name. So that was helpful. Very cool stuff. Thanks for joining me. Hope to have you back. And thanks everybody out there for listening. This is Travis Murphy, your host of the InvestNest Real Estate Investing Show. And don't forget to hit the subscribe button, and please follow us on all our social media at the InvestNest, and check out theinvestnest.com. Travis, thanks again, man. It's been great.
Thanks, Travis. Appreciate it.
All right. Take care.
Thank you for joining us on the InvestNest Real Estate Investing Show. Be sure to join the InvestNest.com and start learning and earning today.